Okay, so we're going to give the participants and attendees another minute before we get started. All right, so just because we have a lot to cover today, I think a minute is enough. We have a few participants in already, and I'm pretty sure everyone else will be joining us shortly. So I'm gonna get started with just the introduction and some house cleaning items that everyone just needs to keep in mind. So today we will be presenting your pathway to homeownership, obtaining a mortgage loan. So welcome everyone. Thank you for joining us this evening this is actually our third webinar of a five-part webinar series on first-time home buyers. I'm Suhey Mojica. I'm the Senior Coordinator of Business and Assets of the San Pablo EDC. And tonight we'll be presenting for San Pablo EDC, Lisa Marie Weathers. Just to get started, the webinar is being recorded. A recording will be available on our website. Any resources mentioned during the presentation will also be available on our website, or you can feel free to give me a call directly. My contact information will be provided at the end of the webinar today so that you can get a hold of us if there's something that you need from this presentation today. We do welcome your questions. So if you see at the bottom of your screen, there is a Q&A box and there's also a chat box. You can enter your questions there and we will try to answer them either throughout the webinar or at the end. Next, I just want to give you a brief, introduction to what we do at San Pablo EDC. We do provide technical assistance for businesses, membership and sponsorship benefits, access to capital, home ownership, job development and career counseling, degrees and certified trainings, and employment and support services, among other services. So if you're interested, aside from the home ownership programs that we offer here, and you're interested in any of these programs, please give us a call and we will be more than happy to provide you with more information. Again, you can also find this information on our website at www.sanpabloedc.org. And then today, just to get started, this webinar was possible with the help of our wonderful partner, Lisa Marie Weathers, who we are very grateful for her partnership and collaboration with San Pablo Economic Development Corporation. She has been a longtime resident of the Bay Area. She earned both her BA and MA in communications from San Francisco State University before becoming an entrepreneur in San Francisco, but she ultimately settled on the work that fulfills her the most, which is meeting and helping people from every walk of life, who understands the value of home ownership, but who may need competent help to realize their dream. So whether you need help with credit, down payment, or closing costs, you want to build, buy, or renovate, or even if you're ready to buy right now, she will work with you closely, help you navigate the wonderful, complicated, and sometimes intimidating process of home buying, and leave no stone unturned until you have the keys to the home that you want and can afford. So with that, welcome, Lisa. If you want, great. So I don't know if you'd like me to go over the agenda or if you want to go.
I can go ahead and do it. Yeah, I can do it. Hi, everybody. Forgive my voice. Hopefully you can hear me okay. I'll be taking a sip of water every now and again, but I'm fine. So we're going to talk about mortgage loan basics, affordability and you, shopping for the right lender and product, working with the lender, steps to the lender takes to approve your loan, your rights as a loan customer, and special financing. Next slide. Okay, so let's start with the basic question, what is a mortgage? Basically, a mortgage is what secures your loan to buy a home. There's a promissory note. It's a legal document that basically lays out your agreement with your lender. It tells you what your interest rate is, what you're borrowing, and the term of your loan. And then you have a deed of trust in California. In California, you can either have, depending on where you are, a mortgage or a deed of trust. In California, the deed of trust is the legal document that says that you actually are using your property as security for the loan the money that you're borrowing. Next slide. So your mortgage payment will include principal, which is the amount of money that you have borrowed. That's the principal loan amount. Interest is whatever your interest rate is that you're going to be paying in addition to the principal every month. Your property taxes, if you're impounding, taxes and insurance, which is property taxes that are due twice a year, and homeowners insurance. It could also include your payment. This is not what you're going to be paying to your lender, but something that you're going to be qualified on is if you're buying a home that has a homeowners association, then your homeowners association dues will also be counted to qualify you for a mortgage. Next slide. To obtain a loan, it's if you're working with the right people, it really should not be a difficult process. It is complicated. There are lots of pieces, but when you have a good team working with you, each person will have a portion of the work to do, and it should be relatively seamless. But of course, when you're looking to get a loan, you want to search around and make sure that you're going to find a lender that you can work with who is going to provide the loan product that you need. Keep in mind and be very careful when you're a first-time home buyer. If you're trying to use a program that like the WISH program or Splash with San Pablo EDC, or you're trying to use something like a Cal HFA or one of the many other programs that is available, you could possibly call a lender that might be, you know, on the corner in your neighborhood, you know, national, international lender. And it's possible that they may tell you that they don't offer whatever it is that you're seeking. So one of the things to be very careful about is to always ask whoever you're going to work with, ask them if they're aware of down payment assistance programs, if that's something that you want to be able to access. And make sure that you're working with someone who has experience, because very often someone who is used to just doing a basic loan where someone comes in and puts down 20% and has all the money that they need for their down payment and their closing costs and all of that is not going to be aware, or sometimes not willing to kind of look everywhere to help you get money that you may need to be able to close this transaction. So research is critical to make sure, ask family and friends, neighbors, whoever you can think of that has bought a home possibly, to kind of refer you if possible. Okay, so once you've settled on a lender, then you're going to get your pre-approval. And there's a difference between pre-approval and pre-qualification. Be very careful with that as well, because you may go to a lender who is just going to take your word for everything and not do the research that's needed to make sure, not verify everything, and tell you, okay, yes, you're pre-qualified for this amount based on what you've told me. And then you go shopping, you get an offer accepted on a home, and then find out that you actually are not pre-approved. So the difference between a pre-qualification and pre-approval is that a pre-approval is where you have submitted all the documents that you're going to have to submit to your lender, and your credit has been pulled, all of your income, assets, everything has been verified, and you have gone through the process before you actually get into contract on a property and gotten a letter from a reputable lender or broker saying, yes, you are pre-approved. There'll always be conditions, but be aware that there is a difference between being pre-qualified and pre-approved. A pre-approval is much more involved process. Okay, So once you have an offer accepted, so you're going to take your pre-approval letter and start shopping. It may, you may get the first offer accepted. It may take you weeks or months, or some people, it could take you years, depending on your situation in the market. But once you start shopping and get your offer accepted, you're going to use your pre-approval letter to submit with an offer to a seller. And then once they accept your offer, that is when the actual loan application starts. You're going to need your contract. You're going to need updated documents, possibly, because you may have come to your lender with a loan information, paychecks, bank statements, a credit report, and all of that may be old. So be aware that once you start the process, depending on how long it takes, you may have to keep updating your lender to make sure that you're still approved. So your loan application is normally done with the pre-approval process. It's a bunch of questions that you will have to answer, and some lenders will do it seamlessly, just speak with you over the phone or in person, however you're going to do it, take the information, and then provide you with an actual completed loan application that you will sign. Others will actually give you the document for you to complete yourself, however it gets done. That's critical, first step, because that's telling the lender, this is my official application and I want to borrow the money to buy this home. Something that goes on behind the scenes constantly is the loan processing. So as you get into contract on a home, your lender may have, your loan officer may do it, or there may be an assistant that's helping to go in and make sure that all the pieces that you need are in place for this loan to proceed. So they're making sure you have all your pay stubs. Generally speaking, you're going to need the most recent month of pay stubs and the most recent 2 months of bank statements. You're going to need your current picture ID, government issued picture ID. You're going to need authorization for your lender to pull a credit report, and you're also going to have to pay for an appraisal. So there are lots of different ways that it can go, but what the lender is looking for is evidence that you are able and likely to pay off this loan. And so if you sat in on the last class that we did about credit, you can remember the things that they're looking for to make sure that you're likely, that you can afford to pay the loan, and your history with credit and your obligations is that you will likely make the loan. So make the payments on the loan. Your loan application, all of your documents, and once everything is all ready to submit to your underwriter, then it goes in line to actually be seen by a human. There are two layers of underwriting. Initially, they'll normally be an automated process, and that's part of the pre-approval where, like, if you came to me and I collected all of your information, the first thing that I'm going to do is put it through an automated system that everybody in the industry is using, that has all of the requirements for loan approval, depending on what type of a loan that you're going to get. We will go put all of your information in, and if we do everything properly, then you're going to get an automated approval that basically tells you, okay, you fit the mold, everything that is needed is here. And so now you can get in line and go and see an actual person who's going to then verify. It's trust but verify kind of a situation. Once the underwriter sees your file and determines that yes, you are eligible for this loan, then you will get a conditional loan approval. And I've been doing loans since 2003, I think. I don't think I've ever had a loan that didn't come through with some conditions. And it might just be, an updated pay stub. It might be questions about something in the file. But generally speaking, if you're working with people who know what they're doing, once you have an automated approval, when you get to underwriting, you're going to have an approval and a few conditions that you are going to be able to meet. So one of the conditions, of course, is that you have insurance in place and that you have an appraisal. The property is going to have to appraise for whatever you're paying for it. And if it doesn't appraise, then if the appraisal comes in low, then either you can't buy that home or you're going to have to come in out of pocket with, pay the difference from your own money. The loan closing is just a process where all of the parties who are working in your on your loan, that means your real estate agent who has the contract and has written up the contract between you and the seller, your loan officer who has done everything to do with the loan, the escrow officer who is making sure that the people who are selling you the house have the right to sell you the house. Everybody comes together, they crunch the numbers to make sure that the seller is going to get the amount of money that they're supposed to get. If the seller has a loan that they're paying off, that is going to be paid in full. If there's money that needs to come from you, that you'll have that, you'll know how much money you need to come in closing with. And then when it's all said and done, your ownership will be recorded with the county and you will have a clear title to the property. Next slide.
Lisa, before I move to the next slide, I have a feeling you might be covering this on this presentation, but just in case, I'm just gonna let you know what the question is.
Yes.
They're asking, how much should I save for a down payment? And I think you have this probably coming up, right?
Yeah, I would say save as much as you can. Save as much as you can is always the best advice. But with that said, it is possible for you to get 100% financing if you're layering various down payment assistance programs. But even if you do get 100% financing and you get over 100% financing, which is some programs available that you can layer a lot of different programs so that you have money for your down payment and for your closing costs, you still are going to need, I would say, depending on where you're buying, the prices in your area, you're gonna need at least a few $1,000s. Let's just say that, at least a few $1,000s, but you'll know exactly what, how much money you're going to need to come in with when you start talking to to a reliable loan officer. That person would be able to, just based on all of the documents that you've submitted, tell you how much you're qualified for and give you an idea of what your closing costs will be. In terms of affordability, your debt to income ratios are critical in getting approved for a home mortgage. So your ratios are basically just taking a look at what your income is and what percentage of your income you can afford to pay on a mortgage. So generally speaking, I'm going to give you best case scenario, and then I'm going to give you real world scenario. So the federal government has decided that 1/3 of your income, your gross. Now, keep in mind, when we're qualifying you for a mortgage, we're looking at your gross income. So we're not worried about how much money you're bringing home, not with your paychecks. We're looking at whatever your gross income is before taxes, because they're giving you the benefit of the tax write-offs that you're going to get as a homeowner up front. So that makes it a little bit easier. But generally speaking, to be in an affordable mortgage, you need to be spending no more than 1/3 of your income, your gross monthly income, on your housing. Now, so most affordable programs want to see that if you're between 33 and 38% of your gross income being spent on housing, that is an affordable mortgage, and that is, what we're looking for theoretically. But in the real world and in the Bay Area, because of the prices of homes, you are more likely to end up spending like 43 to 45% of your income. And then depending on what type of loan that you're going to get, FHA, which is the Federal Housing Administration, allows you, believe it or not, to go up to 47% of your gross monthly income on housing. Now, let's put that into real numbers. Let's say you make $10,000 a month, or you could say $1,000 a month. Let's just to make it the numbers round. Let's say you make $10,000 a month, then you shouldn't be spending more than $3,300 a month on your housing payment. Or in the Bay Area, you're say $4,500. On top of that, they're also going to be looking at what are your debts, because if you have a high car payment plus student loans plus credit card debts, that's all going to take away from your buying power. So a good way to look at it is this: take whatever your gross monthly income is, and like I said, that's before taxes, and then just calculate 45% of that. Let's just say 45%. If your some down payment assistance programs will allow you to go up to 45%, some will only allow you to go up to 38 to 40. So it really is going to depend on what you're trying to do. But let's just make it easy and say you're in a program that's going to allow you to go to 45% and you're making $10,000 a month. That's $4,500. Now, if you have $1,000 worth of payments on student loans, car loans, credit card obligations, then you're going to deduct that from the 4,500, which means that you only have 3,500 now left to be able to pay on a mortgage. If you're making less than $10,000 a month, which a lot of people are making a lot less than that, then you do the numbers based on your income. So the key is figure out whatever your gross monthly income is, take 45% of that, and that's the maximum that you should be spending on your housing plus any credit obligations. And then when you subtract the minimum monthly payment on whatever your credit obligations are, whatever is left over is what you can afford on a home. That's a good way for you to be able to figure out how much you can qualify for without going through a bunch of trouble. Okay, next slide. So once we went over pre-qualification and pre-approval. So in terms of getting pre-qualified, this is the casual kind of back of the napkin kind of a thing where you can talk to a loan officer without giving them any documents and tell them, this is what I'm making, this is my debt, this is what my credit scores are, and they will be able to tell you, okay, this is what it looks like you can qualify for. But just keep in mind that a pre-qualification is not a pre-approval, and nothing is guaranteed until you actually submit your documentation. Someone looks at it, verifies that everything is accurate, everything is legit, and then you can proceed to start shopping. Next slide. We talked about some of this already. I got a little bit ahead of myself. When you're trying to get a pre-approval, you can go to the next slide, Sue. That's good. There are lots of different places where you can go to get a loan. You can go to your bank where you're banking right now. You can go to credit union. There might be, your employer might have even a program that you can use, but there are limitations depending on the lender to what they can provide for you. So like I said, just make sure that you're using a program or a lender who is able to provide you with what you need. If you're a first-time home buyer, you don't have a lot of money saved, or you want to preserve as much of your assets as possible, then you definitely want to look towards a lending institution that is used to working or has a track record and some experience in working with first-time home buyers, of course. And mortgage brokers are, I'm a mortgage broker, so I'm a little bit, maybe not, what's the word I want to say? mortgage brokers are a good option because you might go to lender A, lender B, lender C, and they all have different programs, and maybe one can do something that the other can't. With a mortgage broker, that we have access to a lot of different lenders, and so whereas you might go to Bank of America and they say no, or Wells Fargo or whatever, we have access to a whole range of lenders that if one doesn't work, you can still use all the same documents and go, we can find a lender, hopefully, that will be able to give you what you need. Next slide.
If I may add to that,
Yes.
so basically with mortgage brokers, it's sort of like when it comes to insurance, right? Where you have like captive agents that work for like captive agencies, such as like Farmers or State Farm, just to name a few. They can only work with whatever they can offer, right? And
Yeah.
then for brokers, they actually have access to many more insurance companies. They work for the client, not for the actual insurance company. And from what I'm understanding, mortgage brokers are sort of the same. You are able
Exactly.
to shop around different
Yes.
products and different programs out there. You're not stuck to one product
Exactly.
or
Exactly.
whatever that organization offers. Okay.
Yeah. Of course, if you have a banking relationship and they have what you need, of course, then you go with them, if you have a relationship. But if you're not kind of set on anybody, or the bank that you use cannot help you, then you definitely should look for a mortgage broker.
Or other options.
Yeah.
Okay,
Okay.
perfect.
Next
Thank
slide.
you.
All right, loan categories. So there are so many different loan categories, and it really just gives a lot of different opportunities depending on what your situation is. So there's conforming loans, and there's like an alphabet soup of all kinds of different terms when it comes to mortgage lending. And you shouldn't concern yourself too much with having to know all of this, because you just need to know what is going to work for you. And that's why it's critical for you to work with a partner who understands mortgage lending and is going to be able to guide you and answer whatever questions that you have. When you hear conforming conventional, that just basically means that at the time that you're looking, the market has established that loan amounts below a certain amount will qualify for the best financing, because you're likely to be attractive to an investor who's going to actually buy the mortgage. So you also have, and it's really FHA, which is a Federal Housing Administration, is a government insured loan. So when you're getting a FHA, which is the easiest loan to qualify for and has good rates, and it basically is set up so that most people who are looking for a mortgage will be able to qualify. The guidelines are more lenient. FHA is very popular. Now, you might find that a seller, when you're starting to, you have your pre-approval and it turns out that you're getting an FHA loan, which only requires 3.5% down. A conventional loan for first-time home buyers, if your income is qualified, only requires 3% down. So just depending, rates on an FHA loan tend to be lower. There are lots of different, the loans are, a good loan officer is going to look at your situation and is going to say, okay, based on your parameters, based on your income, your assets, your need for assistance or not, your debt level, your credit scores, then that your loan officer is going to be able to say, okay, this is a better option for you. Or you might be able to qualify for a conventional loan or a government insured FHA loan, and then you can just decide. They will give you the options and then you can decide on your own. So there are, of course, special programs for low income first-time home buyers, low to moderate income. There are even programs for higher income borrowers. The state of California has CalHFA, California Housing Finance Agency. They don't actually do the loans, but they make them available through lenders for first-time home buyers who can make six figures and still qualify for the loan. So this is not information that you are required to know. Just connect yourself to someone who's aware of all the different possibilities. Subprime is there, and it's, you know, it used to be a big thing. Subprime is probably responsible for why the market crashed like in 2007, because so many people were getting like predatory loans that they didn't understand, that they could not afford, and ended up losing their homes. So subprime, I guess it's still available, but there are laws now since the market crashed in 2007 to prevent a lot of things that were happening that to subprime borrowers or people who didn't have the best credit, but who still could afford to make a mortgage payment. Even if you're, and subprime really is different by depending on the lender. Some lenders will think that you're a subprime borrower if you're under a 660 FICO score, and some lenders at that same score would call you a prime lender, a prime borrower. So lots of different options for types of loans that you can get. Just connect yourself with someone who understands all the different options and possibilities. Next slide. We're talking a little bit about conforming conventional loans again. It's based on whether or not you fit the box. Do you, is your income, I'm sorry, is your loan amount below a certain amount? And they change every year. The conforming loan amounts change every year, and they changed just recently. 500, I think it's like over $500,000 is a conforming loan amount now. The guidelines to qualify for a conventional loan are basically that you've got to have credit scores that are acceptable. And it depends on the lender, because some lenders are offering a conforming conventional loan with a 620 FICO score, and some you have to have over 700. It really just depends. I hate to give a hard and fast, okay, this is what a conforming loan looks like, because it really does depend on the lender to say what is going to work for them. Something that I've learned years ago in the mortgage industry is that there are guidelines that are set by the federal government and by investors, but lenders kind of twist them to however they need to twist them. They will do what's called overlays, where the guideline might say that you only have to have a 660, a 620 FICO score, but the lender has decided they don't want to lend to anybody with less than a 700. I hope I'm making the point that just because one lender or one loan officer might say that you don't fit the requirements for a loan, be aware that another lender might say yes. It's very common. Next slide. Subprime loans, like I said before. Now these rates are not comparable to what's going on now. This is more reflective of what was going on when the market was crazy, you know, around 2007, 2008, before everything exploded. This is just basically to tell you that if you are considered to be a subprime borrower, you're going to have to pay way more on your mortgage than what someone who is not a subprime, the opposite of a subprime borrower is a prime borrower, is someone who can go basically anywhere and get a yes. So like I said, there are rules now to prevent subprime loans from taking advantage of people. So you could still probably get a loan with not so great credit, with some dings in your history, with, you know, little things that may have happened. But in general terms, whenever you're getting a loan that is not a prime loan, your lender has determined, okay, you're probably going to pay, but we want to make sure that that we don't get left holding the bag. So we're going to kind of front load the costs. So you're gonna basically, if you're in a subprime loan, you're gonna pay more, and you may be dealing with people who aren't afraid to kind of pressure you, charge you more, give you a loan that is less attractive. So my advice is that if you see yourself being steered towards a loan that is not what you expected, or you feel like you're not really a subprime borrower and you can qualify for better, I would say shop around. Or if you keep finding that you're getting put into a rate that you think is much higher than what you should, maybe there's something that needs to be worked on, something on your credit, there's something to do with maybe your ratios are too high or whatever it is. Maybe before you take a predatory loan, do some work with someone who knows how to fix things, who can look at your information and tell you, okay, this is why you've been put in the subprime category. Here's what we need to do to get you out of that so you can actually qualify for a prime loan, which will be a lower interest rate, lower fees and costs. And in the end, you'll end up with a much more affordable payment. Okay, next slide. Government loans. I said so much about government loans. FHA, Federal Housing Administration, is probably, if you're not a veteran, one of the most lenient loans that you can get. And this is not a loan that's issued by the federal government, it's insured by the federal government. So it has some costs connected to insurance that you will have to pay. With an FHA loan, and FHA, most lenders who are out there can offer you either an FHA loan, like I said, which is easier to get into. And the way this came about is that way back when they started lending, doing mortgages, the federal government decided, okay, we're gonna set up guidelines for borrowers that we think should be getting into homes, but they're not able to because for whatever reason, lenders are denying them. So what we're gonna do is we're gonna set up a program to protect to help borrowers who are being denied loans, help them get into homes, and also protect the lender by providing them with insurance. In case, for whatever reason, you default, then that lender is protected by the insurance that you, the borrower, has paid for. So you might hear people say, oh, don't get an FHA loan, those are too expensive. In reality, some people will not be able to get a loan unless it's an FHA loan. And so one of the differences between a conventional loan that is not insured by the government and one that is insured by the government is that there is upfront mortgage insurance that you will have to pay. It's not money that you have to pay out of pocket. In fact, I've never seen anyone pay for it out of pocket. But what will happen is that when you get an FHA loan, they're going to add right now 1.75% of whatever your loan amount is. They're going to add that to your loan amount. And that's one insurance premium that you're paying upfront to protect your lender. It doesn't protect you. It protects your lender for lending to you because you fit the box that says FHA guidelines say, believe it or not, that you can borrow from, you can get an FHA loan and have a FICO score as low as 500. Now, that's in theory. I have never actually had a borrower with a 500 FICO score actually close on a home, because if someone comes to me with a 500 score or anything around there, I will work with them to get that score up so that they can get better interest rates, get a better loan. But the guidelines do say that you only have to have a 500 FICO score. If you have a 500 FICO score, you have to put 10% down. But if you've got over 580, you only need to put 3.5% down. So if you thought that you needed 20% down to buy a home, you actually don't. With FHA, you only need 3.5%. But like I said, you're gonna have to pay 1.75% mortgage insurance up front. And then if no matter how much money you're putting down, you're going to have to pay a monthly insurance premium along with your mortgage. A lot of people will get an FHA loan up front just to get into a home, and then ultimately refinance into a conventional loan where when they have enough equity to drop the mortgage insurance. Veterans Administration, they actually guarantee the lender that if they lend to a veteran who meets the guidelines, and this is one of those loans where you get 100% financing, and the federal government is saying, we want to help this veteran, and we are going to guarantee you, lender, if you lend to this veteran and they meet these guidelines, then we will make you whole. USDA or rural housing services, they also guarantee loans. So if you're in an area, a rural area that you want to buy a home, even if you have a lot of acreage attached to it, you can get 100% financing also with USDA. And then there are the state and local loans offered, and usually those are subordinate loans or second loans that can be layered with your first loan to make your mortgage more affordable. Okay, next slide. Types of loans. Most people, when you're a first-time home buyer, and especially since the mortgage meltdown in 2007, most people are going to get a fixed rate mortgage. All that means is that when you get your loan, the rate stays the same for the life of the loan. So it's fixed. If it's 3% fixed for 30 years, you know that your payment is going to be the same every month until the month 360, which your payment is probably going to be a little bit less because it's not exact. Your last payment will be a little bit less, but most people are not keeping a loan for 30 years. Most people are refinancing at some point, either because rates have gone down or because their equity has gone up, and they want to take advantage of some of the money, the equity that they've built up as homeowners, or they need money for college, for a lot of different things. So fixed rate mortgage is generally what you would get as a first-time home buyer, and it's because it's safe. You know what your payment is going to be, and you don't have to worry about fluctuations. An adjustable rate mortgage is exactly that. It can adjust depending on what type of a loan you get. It can adjust. Adjustable rate mortgages can adjust every year, every 5 years. Some of them can adjust every month. But rules are in place now to protect a first-time home buyer, to make sure that you have the ability, based on worst case scenarios, they have a roof, a margin. You will know when you get an adjustable rate mortgage that your rate can adjust, how often it can adjust, and what the maximum it can go to, how many points it can go up or down. So there's a little bit of stability when you're getting an adjustable rate mortgage, but you have to be very careful because people have lost their homes getting into a mortgage that adjusted to the point that it got so high that they could not afford it. So you want to be aware. Interest only payments are available again, but they're very limited. And then balloon mortgages, where you pay a certain amount now for a set period of time, your payments are going to be whatever they are, but then in time, it could be a year from now, it could be 5 years from now, you're going to have a huge payment due. And those are limited now because the government is trying to protect first-time home buyers from that kind of a scenario where you have a huge payment due and you have no way of making that payment. Graduated payment mortgages are out there, but I really don't see many of them. But the concept is for people who may have like entry-level job now, but you know that you're going to be making more money over time. You have raises or promotions that are coming up, or as you have more experience, you know that your income is going to increase. That just is set up so that you can make a smaller payment now, but as your income increases, those payments will increase. But that's not something that is readily available. They do exist, but it's not something that the average borrower is going to use. For adjustable rate, interest only, and graduated payments, you have to be very careful and really reserve those for people who really know what they're doing. Like seasoned homeowners who have been buying and selling homes for a while, or investors, they generally, go to those kinds of mortgages. When you're a first-time home buyer, you want to stick with what you know, stick with something that you know is going to be consistent, and no matter what happens in your life. Biweekly mortgages are basically where you're making two payments in a month, which saves you a ton of money on interest. But be careful, because you can do the same thing with a fixed rate mortgage. Because let's say you have a fixed rate mortgage and your payment is whatever it is every month, you can always pay more and pay down your mortgage faster without being required to make your payments every 2 weeks. And then there's shared equity mortgages that tend to be tied to nonprofits, the down payment assistance programs, where you're going to borrow some money in exchange you're going to borrow some money, usually from a nonprofit, a community organization or something, and in exchange for them lending you money, you're going to share your equity. Usually it's a percentage, the same percentage. Let's say you borrow 10% of whatever you need to buy this home from an agency. What they're going to do is take 10% of your equity whenever you're paying them back. Generally, that's how it's set up. They're all different. So you'll have to, if you're going to use one of these programs, be sure that you understand what the requirements are. But a shared equity mortgage is basically they're helping you, and you're going to give them a percentage that is equal to whatever the percentages that you borrow. So if you borrow 10%, when you pay them back, you're going to pay them back whatever you borrowed plus that 10% of the equity. Some of them have interest attached, some of them don't. It's a good option if you need it. But I always tell people, only borrow as much money as you need, and make sure that you don't bite off more than you can chew. Next slide.
Just before we move to the next slide, just wanted to let you know it's 5:48 and we still have 12.
Okay, I'm gonna go faster. Okay, sorry about that.
No, that's okay.
Okay, key mortgage terminology, things that you're going to hear thrown around a lot. Loan to value, that basically is just a percentage. So if your loan to value, the maximum loan to value is say 95%. That means that you can only borrow 95% of the value of the home. Or whatever that number is. With FHA, the standard loan to value is 96.5%. That means you're borrowing 96.5% of the value of the home, and you're putting down 3.5%. Down payment is exactly what it says. It's how much money you're putting down. And don't be afraid that there are programs out there that don't require you to put any money down, but you still will have to have some money up front for your appraisal, for your home inspection, and definitely for moving costs after you close on your home. Your loan term is just how long is the loan going to last. Most first-time home buyers are going to get a loan that's a 30-year loan, 360 months. The interest rate is whatever your lender is going to charge you for the loan, and that's basically their profit. Whatever the lower the interest rate is, the lower your payment, the higher the payment is. So of course you're trying to get the lowest possible interest rate. Annual percentage rate, or APR, is something that a lot of people misconstrue, don't really understand. It's just a shopping tool. And basically what it is that it's allowing you to be able to compare apples to apples between different lenders. So if you go to a lender and tell them you want to borrow some money, they will be able to tell you, okay, this is what our interest rate is. The APR tells you what you're being charged. So it's an expression of all of the fees and everything that is being charged to you in this particular loan, expressed as a percentage, so that if you go to lender A and they tell you that your APR, your rate is 3%, but your APR is 3.5, that means they're charging you 0.5% in charges. And then you go to lender B and they tell you your rate is 3%, but your APR is 4%. That means they're charging you a whole percentage point in fees. So that tells you that lender A is charging you less. A point is just a percentage. So if you go to your lender and they say that they're going to charge you 2 points, that means 2% of whatever your loan amount is. Mortgage insurance, we discussed, is something that you will have to pay if you're getting an FHA loan, or if you're getting a conventional loan and not putting down 20%, or your loan amount is more than 80% of your purchase price, then you're going to be paying mortgage insurance that protects the lender. It does not protect you. An escrow account is very common for first-time home buyers, and that's where you are putting money aside every month as you make your mortgage payment to cover your typically homeowner's insurance and your property taxes. So instead of having a big property tax bill twice a year and a big insurance bill every year, what you're going to do is open an impound account with your lender as a first-time home buyer, and FHA requires this for first-time home buyers. And you will put 1/12 of whatever your insurance payment, your homeowner's insurance payment, and your property taxes, you're going to be paying that along with your principal and interest, 1/12 of the homeowner's insurance and the property taxes with your mortgage every month, so that when that bill comes due, the money is just sitting there in an account and the lender is going to pay it for you. That's a way to protect you from having a huge bill, and it protects the lender from you defaulting or not paying your property taxes. Loan fee is exactly what they say. Some lenders will charge you an application fee. Most will charge you a credit report fee to pull your credit, make sure that you are aware that those are things that you will have to pay up front out of pocket. And they go to the lender to cover whatever the cost is of what they need to do for you. A prepayment is, there can be prepayment penalties. Well, actually not anymore in this market. If you're a first-time home buyer, prepayment penalties are no longer allowed because they're considered predatory. So you don't have to, and that just means that it used to mean that if you were to get a loan from lender A, and then once you close and you've made your payments for a few months or a few years, and you decide that you want to go to a new lender, some programs would charge you to pay them off and go to a new lender. That's no longer allowed. So you don't have to worry about that. Rate lock-in is critical, something that once you start the pre-approval, your loan approval process, if you don't lock your rate in right at the time that you apply for your loan, and you don't have to, you can be watching the market or work with your lender, your loan officer, and decide, okay, here's what the rate is today, and I think that this is a good rate. I want to lock it in. That just means that you're telling your lender, okay, I want this rate, lock it in for me so that I know that my rate is set no matter what happens, as long as I close my loan in time. And amortization comes from the word, it basically means just to pay down your mortgage. Amortization is once you get your loan, you get a schedule that shows on any given day, here's what your balance on your loan is, and here's how much you paid off, here's how much you still owe. Next slide. We talked about all of these things, I think. Document preparation fee is sometimes, it might be considered a junk fee that some people will charge you for doing work on your loan. But basically speaking, if you get charged a loan application fee, that is going to cover whatever the lender is doing for you to make sure that your loan closes and everything that you need to have done is done. Everything else is pretty self-explanatory. Types of insurance that you need to be aware of. Of course, you cannot close on a home without homeowner's insurance. The lender is going to require you, in fact, once you get an offer accepted, that's the time for you to start shopping for homeowner's insurance. A good place to start, if you have a car, is with your car insurance provider, because a carrier, they will usually provide you with a bundle with a price. It might or might not be the best place, the best rate, but that's a good place to start, is with people, with an insurer that you already have a relationship with, and then you can shop from there. Let them give you a quote, and then you can shop from there. Flood or hazard insurance, special hazard insurances, things like flood insurances. If you're in an area that is prone to flooding, then your lender is going to look up and make sure whether or not you're in a flood zone, and they will tell you if you need a flood insurance. Earthquake insurance is another special insurance, and Suhey, you know a lot more about this than I will, than I do, but it's not always required. Title insurance is something that you are going to have to get to cover your lender in case someone should come out of the woodwork and say, okay, you bought this home, but it's actually mine. So when you buy a home, you're going to get title insurance to cover the lender. You have the option to get it to protect yourself as well. And when you're a first-time home buyer, you only have to buy that once. Once you get your policy, when you buy your home, you want to get your your owner's policy, and then that stays in place. Even if you refinance, you have a policy already that you paid for. Mortgage insurance we discussed. Mortgage life insurance is kind of looked on as like a scam. Really, it's basically, but maybe not. It just depends on what is being offered to you. But it's insurance that will protect you in case you die. It'll pay off your mortgage. I don't know, Suhey, you'll be able to talk more about what you think about that, or that's not really my thing, but it is available. And then a home warranty policy is definitely something that you want to look into, because it protects you when you go into your home. If anything breaks down, your refrigerator dies, a home warranty policy that you pay, if you pay for it annually. So when you buy a home, sometimes your real estate agent will actually gift you a home warranty policy. Sometimes the seller will pay for it, but it's to protect all of the appliances and whatnot in your home. It could cover your water heater. It can cover, like I said, your refrigerator, washer and dryer. All those different things can be covered by a home warranty. It's definitely something worth doing. I don't think we really, places, I think we kind of discussed this about shopping for a loan, the different places that you might look to get referrals for shopping. And I see we have 2 minutes left. Really, the way I can sum this up is basically, I would say, connect yourself, whether it's a family member, a friend or family member has referred you to somebody. Just kind of shop around. Use the resources or the connections that you have to get connected to a good lender who's gonna be able to refer you to somebody that knows what they're doing. When you're a first-time home buyer, you're a special breed, and very often it means that you require some hand holding, and you need to work with someone who is capable and happy to do that. Some lenders, loan officers, do not want to waste their time. They consider wasting time dealing with somebody who's going to ask a lot of questions and who needs a lot of help, and they're not a good fit. So make sure that you're working with someone who specifically works with first-time home buyers. And if you need down payment assistance, basically let them know up front, I'm going to need assistance with my down payment and or my closing costs, and I want to work with somebody who knows that field, because not everybody does know. And if you work with someone who's not aware of what's available, they may tell you that something is possible that is not, or they may tell you that something is not possible that is. So you want to make sure that you're going to get everything that you're entitled to, and work with the people who know how to connect everything, connect the dots. Okay.
Great. So I think we have one last question. I know that it's almost 5, but just
Six.
because I think we can go like 2 minutes over.
Mhm.
What I would say is probably you can give them a short answer, but I'm imagining that maybe this participant did not attend our credit webinar
Mhm.
that we had just a few weeks ago.
Yeah.
So I would really encourage and recommend that you go to our website and you take a look at that. But the question is, can you get a mortgage without a credit score?
Actually, you can not, I won't say you can get it without a credit score. What we will have to do is create a credit score. It's called alternative credit. So you may not have a traditional credit score where you have a bunch of accounts that you've been paying and you have a history and you've been rated in terms of your credit risk. So that's a traditional credit score. You can build a non-traditional credit score by using things like your rent, your cell phone bill, your insurance, a lot of different things, even your child's daycare, a lot of different bills that you have to pay on a regular basis that you have a history of paying on time. Generally speaking, if you don't have a credit history, now this is not a replacement for a low credit score. This is only a replacement for no credit score. If you have low credit scores, then you're going to have to do the work and spend the time to get the scores up, which is not impossible and it's doable. People do it all the time. If you're truly someone who just doesn't have any credit, you can definitely build a credit score using all of the things that you pay on a regular basis that you will have to document. And generally speaking, the way it works is that you would have to produce proof of 12 months, maybe even 24 months of cancel rent checks, to show that you've been paying your rent on time, your PG&E bill, your East Bay Mud, whatever it is, whatever bills that you're paying, you'll have to actually document the history. And then your lender will take all of that information and determine whether or not you'll be able to be approved for a mortgage. But it's definitely doable. You don't have to have a credit score, but it's much easier if you do.
Okay. Thank you for that,
Yeah.
Lisa. And I'm sure they would have to work with someone who's knowledgeable and who's been working in the industry that would know that that is possible.
Yeah.
Obviously,
Yes.
like you said, it
Yeah.
doesn't replace having a credit score, but it is possible from what
Yes.
you're saying.
Mhm.
So thank you. I just want to basically say that we do have 2 more webinars coming up, which is a part of this series. Our next one is going to be on shopping for a home and protecting your investment. That will be on October 26th from 5 to 6 p.m. And then our last webinar will be held in November. That would be on special financing, where Lisa will finally only get to talk for half of the webinar, and I will be talking for the remainder, just talking about special financing that's available when you're a first-time home buyer. And that will be held on November 16th from 5 to 6 p.m. You can register for this webinars at our website at www.sanpabloedc.org. Or you can definitely give me a call. This is my contact information. If anyone also would like to, has other questions, I know we ran out of time, and you would like me to connect you to Lisa, I can. So please either email me or give me a call and I can make that connection. So again, thank you to our presenter, Lisa Marie Weathers, for sharing such great information and resources. And thank you for all of you who have joined us today. Again, like I said, if you want to follow up with our presenter today, please give us a call or email us, and we will be happy to provide you with her contact information. And again, please register for the upcoming San Pablo EDC webinars by visiting our website. So I want to thank everyone, especially our presenter, for doing this today. And I hope that you all have a wonderful remainder of the day. So thank you, and we'll see you the next time when we have our next webinar. Thank
Thank
you.
you, Soleil.
All right.
Bye-bye.
Thank you, Lisa. Bye-bye.
Okay, bye-bye.